now.
Hi, everybody. Thanks for joining us. I'm Jennifer Kirschenbaum. I haven't done a video for us in quite some time. And it's my pleasure today to be here with Ben Bush. And I've asked Ben to join us because it's been an interesting 2 years. And to continue to just write on our day-to-day problems and not talk about some of the macro, what's going on, to me seems a bit of a waste of the newsletter stream that we have and our conversation that we've had over the years. And so I thought it was really important to bring on an expert whose job is to look at the market and who knows healthcare and knows the life of a provider. I've been working with Ben for many years. I trust him, and he's given me a lot of really good guidance and really interesting insights into the marketplace over the years from a healthcare perspective. So I thought it was important to ask him to come on today and give us some information on just what he's seeing on trends and what's happening with inflation and the labor markets. And that's why we're recording this for you today. So hopefully you'll get something out of it and appreciate the advice. And Ben, I just want to thank you for your insights.
Thank you. Thanks for having me. I'm glad we did get this together. As you said, I think the need for information now has become a little bit more important than it has been. Although we've been doing a lot of consulting conversations going back to March of 2020, when we were really talking about a lot of government programs and aid to individuals and businesses straight through the pandemic, but to now when we're seeing really the first significant financial disruption that we've seen in this country, going back to really the 2008, 2009 recession. And what's, I think, most interesting to me about this as it relates to our clients is it was, I'm going to say, pretty much predictable, right? When we knew going into the pandemic, when the government made as many moves as they could to try and help economic relief, to help businesses and individuals get through that economic relief, those efforts were basically printing and giving out money in various programs and forms, as well as what they've been doing for years, buying long-term mortgage-backed securities, and lowering interest rates. And so the confluence of that was that we get a lot of free capital floating around the economy. It did help a lot of people during that period of time. And then consequently, which we knew, that was going to create inflationary pressures in the US economy and the world economy, with a Fed that has to try to create what's called a soft landing. Now that has come to fruition. We've seen inflation spike. We've been living in inflation now for a while. And now that inflation has spiked, we're starting to see the market effects and then the effects trickle down into the workplace. And our feeling is that has a very specific effect on healthcare. One of the things we like to talk about is sort of where do we come from? How do we get here? And really dial in on what inflation is and how it's affecting people, and the differences that healthcare providers, specifically healthcare providers that work in a system that their compensation is an insurance-based system, what's unique to them in these times. So if we could, let's start back, sort of where did we come from, right? So we did come from that a period of time, an elongated period of time, where markets and economies have been growing quite fast in the US. Going into the pandemic, we did have a market that was running very hot. There had been a lot of gains in the prior decade. In fact, I remember having conversations for years about is the market overpriced going into the pandemic? And the consequence of that is we're seeing a lot of economic success in all sectors, and especially healthcare. Now, when the pandemic hit, it created a lot of questions, and really, when sending people home, a lot of questions inside healthcare, depending on the specialties, of when we're going to have a return to work, how are we going to cover employee costs, what is this going to mean to us? And as we moved through that pandemic and found that most people were okay, we did see some industries and some sectors get hurt, but most of our healthcare clients did just fine. They were able to navigate through those early months, get back to work, and ultimately, as time passed, continue to get safely back to what we're going to call the new normal. But then you started to see this inflationary pressure kick in. And a lot of people don't really quantify. So for a lot of people, they go, what is inflation? Inflation means the cost of gas goes up, right? And that's true. What inflation really is a cyclical effect of rising costs of goods and services due to any number of issues. In this particular instance, I think the real catalyst for a significant increase in the cost of goods was not just a lot of money being printed and sent out. It was actually the supply chain disruption that occurred, right? So we couldn't get our hands on a lot of things. A great example is if anybody has been working in the home remodel space, which has exploded during the pandemic, everybody was upgrading their houses. And the cost of lumber was the first real, like, holy cow, the cost of lumber skyrocketed and people were going crazy. And then tin and copper. And you started to see these goods and services increasing. And that was because we had a lack of access, right? So when you have a supply demand curve where the demand is way up and the supply goes down, then you start to see an increase in pricing, right? So people go, great, I'm willing to pay more. And so they're going to start charging more to get your hands on those things that are in limited supply. Well, when you start to pay more for those goods and services, there's a trickle down effect. We're paying more for those goods and services. Therefore, I need more capital to do that. What that does is it puts pressure on employers to pay more wages. We pay higher wages, and therefore the employer goes and turns around and does what with their goods and services? They increase the price of those goods and services. Well, now as a consumer, I'm not only paying for an increased cost of lumber and tin and copper, now I'm also paying for higher costs of gas and electricity and jeans and dot, 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 dot. So what do? I go back to my employer and say, hey, not enough. I need more money. And the employer goes, sure. And then they pass on those extra costs to the consumer. So this is the cycle that we're in, right? And we've seen that perpetuate almost exactly. I mean, I would say to you, Jennifer, you've probably seen it in your practice, but certainly in your clients' practices, wages have gone up. Does that seem accurate?
Yeah, I mean, I think we're at the top of the market for demands and hiring, and just in the labor market is really the complaints that I'm seeing across the board is can't find anyone, or the people who are walking through the door, the demands they're making are insane. And I have a lot of practices that are being held hostage by the staffing and labor
Yep.
demands, labor market.
Especially those that have technical expertise, right? So those employers or those positions that need to be filled that require technical expertise are even more difficult because in a lot of our businesses and a lot of business owners, our mantra is hire the personality, hire the values, train the skill. But in some cases, that's just not applicable, right? If you need a trained skill, if somebody has to have a specific license or education to do the job by law, your hiring pool gets shrunk way, way down, and they're able to command more. And then, of course, with the internet and social media, it's similar to having these groups of people communicate almost as a union to say, hey, we can command more, we're able to get more. And so it's sort of universal across the country in commanding higher wages, lower hours, work from home. And this all contributes to the inflation. But the statistic that stands out to me from a labor standpoint is, as we sit here today, there are basically 2 jobs available for every applicant looking for a job, right? That is really difficult to overcome. That gives the applicants a lot of choice. And that's where, the comment we keep saying, and you just mentioned, is like, well, where are the people? Where did they go, right? Now, there are positives to that. We are hearing a lot of conversations around, are we headed for a recession, right? Are we headed for a recession, and what is that going to mean? Are we headed for a recession, and how's that going to affect our portfolio? Now, a recession, just so everybody knows, a recession is defined by 2 consecutive quarters of negative GDP growth, gross domestic product. So it means the US economy is not growing, it is actually retracting for 2 consecutive quarters. And we see this from time to time. I was reading an article from Forbes today. I think they said there's been 9 recessions since 1945. There have been 4 since the year 2000 in our country, right? And recessions happen, and we'll talk about what happens when recessions happen. But now is this forecasting, are we headed for a recession? And The answer is nobody can tell you for sure, but some of the signs that are showing up are indicating that we don't believe that we are heading to a recession. And one of those is the very, very low unemployment rate, right? We happen to have very, very low unemployment rate right now in this country, which is usually a precursor. And so, that's one of the pros coming out is we have very low unemployment rate, which is keeping our economy strong. Another consequence of inflation, or you'd say a pro of inflation that we haven't started seeing yet, is with rising interest rates that we've seen in mortgages and student loan refinance. Typically what you want to see also is rising interest rates in the bank. Now, for years, our clients have been going, you can't get interest in a bank, right? I put $100 in the bank today, and a year from now, it's $100. It's been zero. That's made it very difficult to find a safe place to store capital, right? If I don't want to have a lot of market risk or volatility, and there are a number of reasons that would be true, especially for any business owners or any businesses that are that have a high need for turnover of apparel or any type of inventory. You always need to have cash on hand. You're just not getting any juice on that cash. And so what we expect with the Fed continuing to raise interest rates is maybe we're going to see an increase in interest rates back to a normal spot where I can put money in a bank and get 3% or 4%. And I can retired people can get safe income. The obvious cons are that we're saying roughly 8%, 8.5% inflation. But understand what that means for the consumer. That's an average, right? That doesn't mean everything's up 8%. Have you taken a flight recently, Jennifer? You've been anywhere?
Astronomical prices on planes.
Astronomical prices, astronomical, double in many senses, 100% inflation. You're also seeing this in some of the goods and services people buying. And this does beg the question, right? You ask the airlines, okay, we understand fuel is up, but fuel isn't up 100%. Your wages aren't up 100%. Why are your costs up 100%? And we actually saw there's some talk in Congress are some companies and corporations taking advantage of this to actually price gouge, right? Are we seeing people charging a lot more for goods and services, not passing along the additional cost to the consumer, passing along the cost plus an additional percentage to increase profits? I am not going to say for sure if that's happening or not, but we are seeing some significant profits in many sectors. When we're seeing earnings reports, again, pro con, significant profits, significant earnings in the marketplace does lead us to believe not headed for a recession, but it also is hitting the consumer pockets. Now, what does this mean specifically to healthcare? And I think it's a very important piece here. I mentioned before, many of our clients in all types of healthcare, when we talk about that cycle of inflation, well, healthcare related profits are typically tied to insurance reimbursements. And so for a lot of our providers, the ability to go out to the consumer and just charge more doesn't exist, right? So it depends on what area of healthcare you're in and how you're able to negotiate and what the insurance companies do. But if you're in an insurance driven specialty or practice, you can't just turn around and go, hey, we're going to charge a lot more for this surgery. We're going to charge a lot more for this procedure. If insurance is reimbursing what insurance reimburses, what that means is your cost of labor and supplies are going up, but your revenue may not be increasing at the same rate. Now, historically, we have seen healthcare wage increases, inflation adjusted, be a little bit better than some industries, right? Our healthcare professionals have done okay in that space, but you're not seeing any wage increases in healthcare near the 8 to 9% average. Can't say in none, but in most cases, you're just not seeing those wage increases to keep pace with inflation. And that's true across the board. That's true for all types of business. So,
but Ben, let me ask you where the breaking point is there, because
sure.
We're not seeing wage increases. You're right, because there's no money available. And for some of my practices, they're seeing huge increases on the cost of health insurance, cost in supplies and goods and everything else. Yep. They can't afford to give the loyal employees any raises, but the new hires that they need to fill seats that are being vacated or for growth, they are having to pay more to recruit. So are you seeing any market trends where you think possibly the hiring market is going to kind of ease up, or is there anything you're seeing there?
Yeah. So not yet. I think we're on the precipice of seeing it, and this really is going to be laid out on what we do see in the economy. Meaning, if you start to see unemployment rise, right, you are seeing jobs hire a lot less people. From the last quarter, the report came out today. right? There was a lot less new hires in the economy this past quarter than there has been, a drastic decrease. And that is in anticipation of lower earnings, right? So that cycle is happening. Now, this is new, right? The what we're calling the Great Resignation is sort of the term that's been coined for this period of time, where a lot of people left their jobs, found other revenue streams. The Great Resignation is certainly new, right? We hadn't seen this. And to your point, do we see changes? I think what you will see as prices continue to go up, which is happening, and hiring slows down, the end consequence is people are still paying more for goods. And unless if that other job or other occupation, a lot of people went to stay-at-home occupations that might be paying less, but that's because they were not commuting to work or having other issues. But as their pricing pressure increases, you're going to see people seeking jobs that will pay more. That might create a return to normalcy. Another thing that's true, and this was actually a Simon Sinek conversation. Simon Sinek, who wrote many great books, The Infinite Game recently. He talked about this almost being like a wage correction, right? Where for years you had very low wage inflation in the middle class, and that the outcome of this, now years of yet decades of that economic pressure, is what you're seeing is the middle class is going to get a wage increase and it's going to stay, but it won't continue to skyrocket, right? That there will be a plateauing because you're going to create new competition, right? So it's tough for me to predict that, but we were just talking about this before we got on the call. In our firm, in our business, we are also out there hiring. We've increased our team by a large amount over the last 12 to 18 months. And it took time. It took time to find the right people. However, we were not willing to put a person in place just to fill the seat. Steve Jobs famously said, it's better to have a hole than an asshole. And I think that that's true for most businesses, right? So I think, our advice to our business owner clients or those that are in charge of hiring is, unless if it is dire straits, if the business won't continue without having a person in that seat, don't handcuff or hurt your team by hiring the wrong person. The right people are out there. They're willing to work. It just takes a little more time now to find them. And yes, we have to be creative in compensation packages. Here's another thing. If somebody comes for more money, they will leave for more money, right? So at some point, the conversation in the room when you're talking to potential hires or current employees is, if it's all about the dollar, there's not a lot you can do. If you're just going to go from $60 an hour to $65 an hour for skilled labor, or somebody saying, hey, down the road, I'm getting 4% match in my 401k and you're giving me 3%. If somebody comes for a little extra money, they will leave instantaneously for a little extra money. And so what we're talking about a lot is, one, being a little bit more creative. Are there things that are out there that, a lot of times we'll look at what corporate America is doing to secure their top talent, and can we put those kind of compensation packages in small business and healthcare? And the answer is a lot of times, yes. We can get more creative and provide loyalty bonuses or long-term non-qualified deferred compensation plans if they're designed correctly. Or are there other ways we can help our employees through this period of time that don't create permanent wage inflation? For instance, gas is up as high as it's been in a very long time, $5 a gallon. One of the things we like to do for our team is we handed out $100 gas cards, right? We're probably going to do something like that again. We recognize that that's hurting their pocket and we want to help. But by doing that, until, we start to see supply chain and hopefully what's going on in Russia, Ukraine, hopefully coming to some type of resolution at some point in the future, gas prices coming back to normalize, what we've done is we've bridged the gap without adding permanent wage inflation, right? So I think there are certain ways that we can talk about and get creative, but ultimately one of the things that we play on is also creating an environment where people want to show up to work with people they want to work with. That's going to create stickiness, and focus on that, as well as how much you're paying and making sure you're competitive.
100% agree.
So, another thing that we talked about, and all of this ties in together, is the supply chain issues, right? Supply chain issues are another big driver of inflation right now. And when is that going to get resolved? I had read some reports that were targeting mid 2022. So really by next month, that was going to be a time that we should start to see some nice significant easing of the supply chain issues. That did get kicked out. A lot of that was when China went back to their lockdown early in the year. They started to see an increase with Omicron, and they had the zero COVID policy, and so they sent everybody home. That is always going to have a pretty dramatic impact on not only U.S. economy, world economies, because so much is produced in China. And then ultimately, we are finding out that there are supply chain issues that are related to what's going on in the Russia-Ukraine conflict. There are a number of things that are developed or made in Ukraine that are then ultimately tied to some of the things that are manufactured in China. And so that's creating a push out. However, the supply chain issues will get worked out, right? We will not be working, we're very confident that the supply chain issues will work out. One of my clients actually works for a company that does international logistics, and she is compensated based on performance. And that is getting her clients what they need from overseas. Now, her income went up massively, right? During 2020, 2021, she was making a lot of income because people were willing to pay a lot of money to get their goods that are manufactured overseas over to the United States. And even she disclosed to us that, there was some conversations about, hey, get ready for your income to start slowing down again, right? They're predicting that they will not be in as high a demand pretty soon, that the ports in California are going to get freed up, that we're going to start seeing these supply chain issues get resolved. And once those supply chain issues get resolved, the imbalance of that very basic economic supply and demand curve will start to balance out again, and we can start to see a drop of the supply chain issues, increasing the cost of goods and services. And that, coupled with the Fed and their attempts to combat inflation by increasing interest rates, should help to curb inflation. Now, how does this relate to, sort of where we are? And a lot of people ask us about, like, what about my accounts? What about my investments? How is this going to affect what I'm doing in the markets and my retirement accounts? And of course, it's not only all interconnected. We've seen a pretty drastic sell-off in the markets so far. So what we saw in anticipation of rising interest rates, starting really back in November, is when we really started to see the market sell off. It went back up, and then the consistent sell off early in the year. The question was, is that because we're in a recession fear stage, or is that because of inflation? And our belief at our firm is that it's more tied to inflation than recession. And so as you start to see recession, tamp, let's say, moderate, and then start to slowly go down, we don't think it's going to be a straight vector down. It's going to be a slow tamp down, that you will start to see hopefully some market recovery. There's always factors that play into that, right? You can't just say because inflation's going down, markets are going to recover. There are like 30,000 data points that get reported that are affecting markets, and you always hear it's the punch you don't see coming. But we do expect, as inflation starts to tamp down, that you can start to see market recovery. Now, some interesting points. Even if we do go into recession, right? Historically, again, this is in a Forbes article I was reading today. Historically, going back to 1945, the S&P 500 has averaged a 1% increase during recessionary periods. Okay. I will tell you why. That's because markets tend to peak before recessions happen, and they sell off, and they typically hit their bottom on average about 4 months before the recession finishes, meaning they start recovering before recession comes back. Now, I can't predict if we are at the bottom or not, but I can say that we have sold off. The S&P 500 sold off pretty significantly. Markets have come down, and if you've had the discipline to remain in your strategy, whatever that strategy may be, to stay inside your risk allocation that you had prior to the market sell-off, haven't made any drastic changes there, or tried to guess at the top or bottom, you will get rewarded for that. And this is, again, just 101. And sometimes people don't like to hear it because they think we or anybody should be able to predict when the markets are going to sell off and when they're going to recover. And that is a fool's errand, right? If you're going to time the market, you have to be right exactly twice. And like nobody is, right? So when it comes to investment and investment strategy, I think there's two things that come to mind. One, understand what your investments are there to do for you. They are, in our mind, an inflation adjusted holding tank for money, right? Our clients who are very capable of creating real wealth, sustainable wealth, multi-generational wealth, they're not looking at their 401k as their wealth creation vehicle, right? They're looking at a place that they can park some money, get some tax breaks, and ultimately have it grow relative to market performance. The most wealthy clients we deal with and the clients that we like dealing with understand that if you really want to create sustainable wealth in this country from a financial standpoint, you have to do one of three things or a combination of three things. One is invest in your business or another operating company, right? So if you have questions about where you should be investing, if you happen to have a business to invest in or a related business, something that you can invest into, a good example, again, a lot of clients are bringing up surgery centers, right? A lot of clients have the opportunity to invest in surgery centers. Now, I don't know if every surgery center is going to be successful, but if you're in a healthcare related business, then you're performing procedures in that surgery center that you have an outcome on it. It's in your space, you understand it. That might be a great place to invest money, right? Maybe, and that should be evaluated. But we've got some clients getting very nice dividends, investing in surgery centers, and they're performing there, and that comes up a lot. So invest in your business or another operating company. 2, income producing real estate, right? Understanding how income producing real estate can benefit you. That's both residential and commercial. Some of the tax benefits that come along with it. That's a nice place to invest money at the right time. Again, it requires analysis. Keep in mind right now, in many areas and many pockets of the United States, real estate valuations are way up and interest rates are up. So is right now the right time to buy real estate? That would be a conversation for the individual, right? And what you're going to use that real estate for. But long-term income producing real estate is a great place to create wealth. And 3, financing deals. So understanding how the financing system works, learning how to get on the other side of the lending equation may not be for everybody. But I would contend in this country, those are the 3 ways that wealth is consistently created. We leave out inheritance and divorce, but are happy to work with people that get their wealth that way. But ultimately, if you believe that that's true, that those 3 areas are how we create wealth, then I would say, great, how we're positioning our other assets in these various different buckets, whether it be a retirement plan or a non-retirement investment or other savings vehicles. We should be positioning and treating those buckets as what they are, which is sort of a support system for maybe these other ventures, right? And it's no coincidence that the vast majority of the wealth in this country and around the world ends up falling in the hands of a very few people. I think that they think uncommonly. I think that they approach their finances, money, and business differently than everybody else. And I think that they have that general understanding that what's going on in the markets right now for those people, it's a blip on the radar. It generally is not affecting them negatively. If the market sold off 15%, if they're really savvy and they're business owners, or they're really savvy in their ability to create wealth, all that is creating is opportunity for them, right? All they're saying is, great, I can take some of my dry powder, my cash on the sidelines, I can put it in the market. The market's announced a 15 or 20% off sale. Great, I'm just going to continue to fund into that sale to go ahead and get the recovery whenever that does happen. So I think that there is certainly opportunity in the marketplace. That's true for physicians or anybody else. But if you are looking to really take advantage of this, I think you should first look at, there are places I can invest in myself. And if that option or the timing is not right because of circumstances, then how am I treating these other buckets of money? Where am I putting it? We can evaluate that and just make sure that you're maintaining a disciplined system and using generally a unrelated third party to help you have objective decision making rather than purely emotional, which is what we tend to do around money. Money is very emotional for everybody.
Super helpful, Ben. Really good advice.
Thanks. Yeah, I mean, I think the only other thing I would say is over the next couple months, there's going to continue to be news, and most of that news is going to sound like bad news or predictable bad news. Remember, that's what sells, right? When you turn on the news, somebody getting on there and saying things are fine, we're going to be okay. That's not going to draw eyeballs. It's not going to drive ad dollars to that channel, news network, or show, right? So, when you are listening to talking heads, they need to be talking about massive inflation. They need to be talking about recession. They need to say, oh, it's going to another 10% down. That's what sells, right? The Fed has a very difficult job to create this soft landing. To raise interest rates without having significant financial disruption is a Herculean task. There was trillions of dollars printed and put into the marketplace in a very short period of time to help with the pandemic. And now they're charged to sort of back that off and get us back to normalcy. I don't know if it's going to be a soft landing. There certainly could be continued market disruption. But I do know for our clients, we are generally optimistic. This time is different than the last. It always is different, but it's not really different, right? We've gone through as a country a lot of economic challenges in the past, some more significant, none exactly the same as this. But there's confidence that as the world is coming into a global reopening trade, the world is trying to work its way out of COVID, those supply chain issues get resolved. We don't know how long Russia-Ukraine conflict is going to last, or what other derivative effects that may have with China. But geopolitical conflict is also not new. And so what we are trying to help our clients figure out is, how do we get through some of these labor issues? How do we get the right people in place, continue to grow our business, manage our cash flows and revenue, make good objective decisions on how we're approaching our financial systems, and ultimately come out of this better than we were going into it, because we were able to take advantage of this disruption.
Thank you, Ben. That's really helpful, and I like the positive spin on it.
I happen to be the world's worst optimist, so take that for what it's worth.
Uh-oh, you shouldn't have added that last part.
I don't mind. I don't hide behind it.
All right. Well, I think that's probably more than they think they signed up for. It's fabulous information. I think the points that you made about the recession indicators is new news probably for a lot of people who've listened today. And I just want to thank you for your time.
Yeah, if anybody does want, we do have some content around that. Again, whether it's written, we do outlooks that we post on our website, and we also do have some video content where we talk about this in a little bit more technical. You can go to our website, which is www.northeastprivate.com. Check out some of that information if you'd like, or certainly to get in contact with us if you'd like to have a discussion.
Yeah, definitely. When we distribute this video content, which will go out within a day or two when we're recording this, which is June 2nd, I'll certainly make sure that your contact information is in there, so anyone who's listening can contact them with any follow-up questions. Ben works with thousands of healthcare providers across the country, and I ran into him over 10 years ago working with residency programs and doing free information sessions and things like that for healthcare providers. So it's been a pleasure over the years. I've learned a lot from you, Ben, and I look forward to continuing to tune in to have you help guide me through the next couple of months. So thank you so much for your time. Looking forward to the labor markets loosening as well.
Yes, likewise. And thank you very much. I look forward to seeing you again and hopefully grabbing lunch soon.
Yeah, sounds good, Ben.
Bye.
Have a good day.